All right. You guys, this is being recorded. One thing I say at the very beginning of all these webinars is watch this again, especially if you guys are new to options trading, okay? Because the first time through, you're going to have questions. You're going to be like, what is he talking about with delta and probabilities, da, 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 da. If you watch it again, all of that stuff will sink in. Also, please feel free to reach out with any questions you guys may have at any time, because I want to make sure that that answer is clear, or that answer is answered, and that person and or everybody else is clear of concept. If you have a question, somebody else is going to have that same question as well. But the real key here is watch this relatively soon after, because you will learn it and remember it for a longer duration. Just watch it once. A couple weeks down the road, you're going to be like, what were those rules again? Okay, so make sure you do take care of this. How do we access the recording? Robert, we're going to be sending these out to you guys. It usually takes me a little while to compress it, download it, upload it, and then send it all out. But you guys should be getting it relatively soon afterwards. So that's when I say watch it again, as soon as you get it. It'll help you remember everything. Okay? Cool. All right, let me get a couple things out of the way. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I started trading with some money I had earned in high school, and I started trading in college, is how I want to put that. But I started out with a psychology degree, and when I started realizing I loved the trading, switched over to finance. After graduating from college with a finance degree, I moved to Chicago and started working on the floor of the Board of Trade as a runner. One of these guys, I don't know if I have a picture here, but one of these guys here off to the side, down here in the corner, as a runner, basically they bring stuff into the pits. Then I sold all my stocks and everything else I owned that I could sell for money to buy my badge, and started trading on the floor with my own money. So I've been trading my own money ever since college, and I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products, just about in all market conditions. Got to do this, guys. Any opinions, news, research, and analysis, or other information contained here are material provided by Pro Trader Strategies and or associated companies and or employees. Should be considered general commentary, you guys. I'm here to teach you guys how to trade. I'm not here to trade for you. I know there's guys out there that are like, hey, follow my stock picks and all of that stuff. I don't do that. The reason why is because you guys already have a portfolio. You guys already have things going on. You have a 401k. I don't know what's in all of those things. I don't even know what your risk parameters are. So what I'm doing is teaching you different things that you can implement yourself, but you need to make sure it is appropriate for you. And past performance of any trading system or methodology is not necessarily indicative of future results. All right. You can follow me on Twitter at Wolfman's Blog. During earnings season, I tweet out all my, I try to tweet out all of them. Every once in a while, I do forget when I get jammed at the end of the day. But I do try and tweet out all my earnings trades. I talk about all of my trades in the daily market commentaries. Every day, I talk about what trades I'm putting on, what trades I'm taking off. I talk about the economic, geopolitical stuff, all the economic data in those market commentaries. So if you want to get all that information, you got the daily market commentaries. But because I do those early in the morning and earnings trades in the afternoon, I want to make sure you guys have an opportunity to know what I'm doing there. So I try and keep that full disclosure and make sure everybody knows that what I'm doing ahead of time rather than in hindsight. Because I don't cherry pick trades, you guys. I talk about the bad ones as much as I talk about the good ones. All right, and this is going to be on ladder puts with correlated underlyings. Now, one of the things all of us have somewhere, or at least I hope you guys have somewhere, is a portfolio that you don't really touch a whole lot. You know, you have your stocks over there that you add to every once in a while. Now, I don't talk about that portfolio in my daily market commentaries. I mostly talk about my options trading and my margin account. But your 401k, all of those other ones are having stocks in there. And if you're running an IRA, I hope you have a few stocks in there as well. When you go to add stocks, you're going to talk to like financial advisors. They always say, dollar cost averaging is the best way to get ahead in the game of owning stocks. That is true. But going to your advisor and saying, I want to buy XYZ at 100, and if it dips to 175, I want to buy some more there, and so on and so forth. So when you are getting that, yes, this is being recorded, and we're going to be sending out the recording almost as soon as this is over. John, I talked about I have to do some things that you have to convert, and then I have to upload, and then download, and all of those things. So that does take a little bit of time. But when we want to add stocks to our portfolio, this is, as far as I'm concerned, the best way to do it. When you put an order in, a GTC order with your advisor or on your platform, hey, when this stock dips down here, if I'm not watching, I want to be filled on it. So if XYZ is trading down to 100, that's where I want to get in. All right. Well, that's great, but that doesn't do anything for you if it never happens, right? You can't benefit from it never coming down there, other than if you own the stock and it goes up, obviously you're making money. But with this laddered puts, what we are going to be able to do is increase alpha and lower our basis of what we paid for that stock, okay? So if we have a stock portfolio, XYZ is already in there, and I'm thinking, if XYZ gets down to 100, that's where I want to buy it. You can put that order with your broker, which is just, holding margin. You can't, right? You're going to have those secured, so in case you want to buy that. But with the puts, you could sell those 100 puts and collect the premium if it never goes down there. Therefore, that premium you collected lowers synthetically what you paid for that original stock. Or you can think of it as I got an extra dividend, or however you want to think about it. That income lowers your basis on that stock ultimately. And then what that does is that increases your alpha. If you can lower what you're paying for something and sell it at a higher value than what you would have normally, that is increased alpha in a sense, okay? So that's what we're trying to do here, is increase alpha of our portfolio, right? And if it never gets down there, we've lowered our basis. If it gets down there, it's to a point where we were going to buy it anyway. And therefore, we'll let them put us the stock because that's where I want it. I got to still keep that premium I sold the puts for. So if I sold the puts for, say, 50 cents, so I sold the 100 puts at 50 cents for the stock that I want to buy. The market comes down to 100, I get put that stock. Well, because I collected that 50 cents, I really bought it at 99.50. So I bought it below market value in a sense. Yes, of course, it could go to 99.98, but that original where I would have normally bought it with a broker for 100, I got it at 99.50 because I got to collect that 50 cents per contract, okay? Title screen is still showing. This one, yeah, sorry, I went past that. We're on to this. We'll go on to this. I was just giving a little explanation of why I think laddered puts is more important than going out there and just trying to put a bid in on a stock. This is the much better way to do it. And we're going to try and do it with correlated stocks. So, for instance, if you watch the markets right now, they talk about the FANGs, which is Facebook, Apple, Netflix, and Google, right? So those have a tendency to move together, which is kind of why they're bunched into the FANGs. And then we're going to be looking for those type of correlated stocks to do this in. Because let's say I'm light in the tech sector or something like that. That would be a situation where, okay, I want to pick up one of these couple of stocks. If one of them gets down there, I'll take it. Okay, that's kind of what we're looking for. Other ways to look at it is I want to own either this stock or that. They could be completely uncorrelated as well and still do this. I'm going to be looking at correlated stocks for the most part today, but if you had a complete opposite correlation, you're like, well, Apple and Pepsi are completely uncorrelated where it's a negative correlation, but I want one of those in my portfolio. I think they're both going to do well, whichever one comes down. So you can kind of play around that way as well. That would be expanding on this. But with this strategy, we do want volatility collapse. So when I first started teaching this strategy, I was hell-bent on having high volatility for these. The more I've done this, I'm not as hell-bent on having that, because ultimately I want the stock. And if the chart's setting up and everything else is setting up to where I think it's going to come down there and I have that possibility, I'm going to be willing to bend some of my rules for that. And volatility is going to be the one that I allow to bend on that, because ultimately we're trying to add some of these stocks to our portfolio. That's our main objective here. Okay. So, but we do want volatility to come out of this stock, and theta contraction. Anytime we're selling premium, which we're selling puts, we want this theta contraction. So we don't necessarily want to go way out on the when we're laddering these puts, because laddering puts means I'm selling options in this cycle here, and let's say it's September, and then I'm selling out here in October as well. Okay, so that's the laddering of puts. All right, that's what we're going to be trying to do, is take advantage of this, and this is going to be a higher strike than this one as well. So that's also the lower strike, because we're talking about puts than the nearer term expiration. All right, with this, we do still have a bullish assumption, right? If we want to own this stock, we ultimately have a bullish assumption over the long duration of this, but we're looking at maybe a correction here and there. However you use your technical analysis, maybe you're using Fibonacci, maybe you're just using, pricing, where, hey, a 10% drop in XYZ is where I want to get in, and that's where you're always looking to get in. Next time you start doing these laddered puts, you're just looking at a 10% reduction. The next guy could be looking at a Fibonacci support. Okay, however you set these up is fine by me. I have certain rules with delta, because I trade by the probabilities. I don't really care about all the other stuff. I do use Fibonacci. I do use market profile. I do use Bollinger Bands every now and again, right? I do implement all that stuff into my trading regimen. Ultimately, I'm looking at probabilities though, okay? And with this, so we're going to be selling a naked put. Naked put is just, you are going out there and selling a put out of the money, and there is no defined risk to it, right? It would be like buying a stock. You buy a stock, there's no defined risk to the downside. It could go to zero. Most people don't realize that when you're selling these puts and stuff like that, yeah, I'm selling a put, it's naked, and yes, I do have risk to the downside. Well, you have the same risk really than you do with the stock itself. But this, if I don't ever get hit on this put, I get to collect that premium. So to me, it's a win-win. I'm lowering the overall price I paid for the stock. I'm increasing my overall alpha in my portfolio, which is very difficult to do. And I get to add stock if the market moves in my direction, or moves to my strike. Okay, and we can do it with selling a put spread. If we're doing this to sell a put spread, you're trying to limit your margin, stuff like that. You may be able to do that. I don't do this because that limiting of the risk to the downside also makes it a little bit less probable in a sense. Your probabilities of success are less because you have that long put in there that is defining the risk. Okay, you're not going to be able to collect nearly as much money either. Okay, but you can do it. Another thing is if you have, you may have to do this as a cash secured put. Okay, and that just means in some margin accounts they make you put up a % of what it would cost to take on that allotment of stock, okay? Which is fine, because we're looking to take it on anyway. So it's going to be this, if you're in the cash secured put scenario, that's going to cost you about as much as if you just put in a bid with a broker for the most part. They're going to make sure you have that money to buy it. Cash secured put, they're doing the same thing. They're expecting you're going to take this stock. that make sense for everybody? But you can do it as selling a put spread to do that, but we're still going to follow my rules on a put spread, and that would be collecting somewhere between 25 to 33% the width of the spreads for those of you who have been around for a while and have seen that. But you can sell a put. I default to selling the naked put. All right. What do we need with this? This was one I put number one, high implied volatility. That is really important. I'm not going to lie. It will help you out dramatically because it gets you further away from where the underlying is trading. All right. And that's why I really like to have that high implied volatility. That's best case scenario. And one thing I look at all of these and I say, you know, look at these as like a green light, yellow light, red light. You know, a green light would be high implied volatility above 50%. We're right below it. Let's say it's around 40 or something like that for a stock. Then that would be like a yellow light. If it's down around 10, 20, I'd say that's a red light. I would stay away from it unless I really wanted this stock and everything else, maybe the other stock I was correlated to had high implied volatility. Those are some of those things you're going to have to weigh on your own because I don't know your risk parameters again, right? If you have lower risk parameters, I would wait till you had the high implied volatility because then you're further away from the underlying. And when volatility comes in, you're going to be able to achieve profitability faster. When you're in really low implied volatility, there's one way volatility usually goes, and that's the other direction. Okay. So when it's really high, it usually goes down. When it's really low, it usually goes up. So if we're getting in at low implied volatility increases, we could be directionally right, being the market goes up, but we could see ourselves losing money because when people are buying puts to protect the downside, that's where volatility goes into those puts. All right. And therefore, we're able to get further away. That's going to help us out here. When there's low volatility, people aren't really buying puts. They're not worried about the downside. We're going to be closer to the market. So I'd rather be further away. And we're going to be trying to take advantage of this volatility, this theta coming out. And 45 to 35 days to expiration, entering the trade is what we're looking for because then we get a massive drop off in theta. And if you guys have been watching these videos for a while, you know that theta, when it is decaying, the further out, if you had a chart like this, and this is the time going this way, and this is the strike price, the value of your strike, you would see further out in time, it kind of goes like this. And then about that 35 days to expiration, you start seeing this really come off. All right. That's theta decay. And in 35 days to, if this was 35 days to about 7 days here, there is about a 50% reduction in premium throughout this time. And that's really what we want. When we're selling them, we want to get that premium collection. And that's how we get it. If you get out here at like 90 days, you're going to be like watching this day in and day out, and it's not going to go anywhere. You're not going to see that theta decay. We want the theta decay. Somehow my charts got a little bit out of whack here. All right. I'm going to sit on this one for a little bit because option pricing has skew. A normal bell curve is going to look like this, but we know that most people buy stocks, and with the volatility we've seen in the last couple of years, we've had some major corrections. People have gone and pushed this bell curve, which creates skew. When you're buying puts, all right, when people are buying puts against their stock to protect to the downside and selling calls against it to reduce basis, premium value in calls goes down and premium prices and puts goes up. Okay. So that creates skew to the put side. Now, this is where it gets confusing. One would think negative skew means the puts, because puts are to the downside, is negative. That's not the case. Positive skew with this long tail to the end is normal because people are perceiving risk to the downside. All right. That negative skew is considered inverse to normal skew in a sense. So that would be to the call side. All right. But what this tells us is where opportunity is. All right. I don't really care what everybody else thinks the direction of the market's going. I know that if they're jamming the puts, buying up the puts, they're creating skew. And it's only because of fear. Volatility is fear, and the skew is created by the volatility curve, okay? As volatility gets pumped up in the puts, it creates that positive skew, all right? And then that's what we want to take advantage of. When people are fearful, usually when people are afraid of something, it's a little overdone, don't you think? If somebody's scared of a spider, you know, you're like, okay, that little spider is not going to do anything to you. It's a little overdone. That's what fear does to people. It makes us go a little irrational. And when they're buying puts, because they're irrational, they don't care what they're paying for. They just want the protection. And they're going to pump up that premium for us. And then we're going to take advantage of that skew in the puts. The other thing is, we want to, normally when we're selling naked puts, right, I'm always talking about that 16 delta because I don't want to get hit on this. Now we're going to go to about, that 16 delta is one standard deviation. If you add up all of these percentages to this side of this line, that would equal 16%. If we go into the half of standard deviation, we're looking at around the 30 delta, okay? I like to go with the 36 delta because 36 to 33, because that way, if I put on 3 of these, I know that I'm probably only going to get hit on 1 out of the 3, right? So I get to collect the 2 premiums. I get the stock, which is what I want. I do it again and again and again. I collected the premium twice, got the stock, and I'm dollar cost averaging, all right? Even in an up market, even if this market's rallying, you can move your strikes up because that's still dollar cost averaging, right? You bought it low, but it comes down and hits you. You can still buy it on the way up. There's nothing wrong with that. But so we're going to be looking at around this 36 delta with 35, about 35, 45 days to expiration and picking the half standard deviation, right? Which, 33% probability of being in the money, 60% probability of being out of the money. Is everybody still with me on this? I'm going to pull up the platform and everything else in a minute, but I want to make sure you guys are clear of concept. And now with these 2 stocks, we want a high correlation, right? Because we're trying to pick this sector. Maybe, we saw not too long ago, the blue chips were going through the roof with the Dow Jones, and we was watching the NASDAQ with FANGs and the tech stocks getting crushed. Now we're starting to see that flip where now they're starting to rotate into tech and out of the blue chips. So we are in this situation trying to go the opposite of that, right? When the tech is getting beat up and the broader markets are rallying, that's kind of when we're going to be looking at those correlated stocks. So we'd be looking at NVIDIA, Apple, Adobe, and stuff like that, and thinking, okay, I want to add some tech. This is the time to add it. Let's start doing some correlated ladder puts, and I'll get one of these possibly, and maybe 2. And when I was saying with the other one, maybe you're looking at 2 stocks that you want to add to your portfolio. Maybe they're completely unrelated, but you're like, I really like Apple and I really like GE, all right? And those 2 are, GE may have been a bad example, but maybe they're negatively correlated by 70%. But you want to add one of those, then you could do this with that as well. Because if one goes up, right, expectations of a negative 70% correlation would mean the other one is most likely going to go down. And then I would be able to pick up one. We don't know necessarily which one's going to go down, but we want to pick up one, and therefore we could do that with a negative correlation. How do you come up with a negative correlation? Great question. One of the easiest ways is to go to this website, and it's not a hot link. So if you're watching this on recording, you can pause it. You can also punch it in real quick. I'm going to pull up this website so you can see it here. So it's right up here in the URL. I don't know if you want to write all that in, but This is great. If you sign up for it, it's a free website. I have no interest in this company. No, I'm not trying to pump these guys for any reason other than they have this great way to see correlation. And you can change all these. I can put in whatever stocks I want. And don't always try and put in the ones you think are correlated. Believe it or not, there's a lot of stocks out there that are correlated you wouldn't believe. We can look at XRT is the retail stock, right? Obviously, Macy's should be correlated, but look, it's not correlated as much as we would expect. I would expect a much higher correlation than that. More like Lulu and XRT, right? Lulu and XRT is an 80 correlation. But we can find some other ones in here that are have a crazy correlation. XOP and XRT. Who thought that oil and gas and retail were going to be almost an 80% correlation? I mean, so play around with this and look for those correlations. You can also look for the negative correlation. Macy's and Coke. If you're like, I really like Macy's, I really like Coke, they have a negative correlation. I want to add one of those to my portfolio. That's the type of situation I was talking about, to throw it in and around that. SPY and NVIDIA, a 97% correlation. That's pretty good. One thing I would suggest is maybe below 90% correlation, because when you get up to the 97% correlation, right, what's going to happen? You're probably going to get both. I don't necessarily want to take both. I want kind of one or the other. If you do want both, then that would be a different scenario. I usually I'm kind of looking like, okay, well, I'm comparing apples to apples here. I want one. I don't care which it is. I want a highly correlated. So therefore, right around 70. So who would have thought Lulu and Adobe would be correlated? They are, right? So that's why you don't always want to just pick the same ones, right? And, Pepsi and Coke are generally pretty tightly correlated, but know that they have very different business models, believe it or not. Yeah, Pepsi and Coke, they're soft drinks. Well, Coke is really into drinks or, liquid consumables, whereas Pepsi is like 70% of your snack food aisle. The chips and all of those other ancillary things that go along with it, okay? Not just Coke and Mellow Yellow, if that's or not just Pepsi and Mellow Yellow. I think those are both Pepsi products, but Pepsi is much more diversified than Coke. So we look at this, you can change them around and try and find your correlated stocks. That's what we're looking for, all right? And then I'm going to be looking to start with about a 35-ish delta. That's what I was talking about, somewhere in that 30-ish delta, because my idea here is I kind of want to win, put the stock on one and then get to collect the premium on the other two, right? Because then I continue to lower my basis and get the stock. So that's why I'm trying to pick something a little bit further out than 50-50, but I also want a pretty good probability of this getting hit, and therefore I get to get that much bigger premium as well. All right. And then we want to set this up when that stock maybe is at a price extreme. All right. Where you're willing to have that underlying put to you because you're negative. So that's one of those rules. Really, the rule here is that you have to be willing to want to have that stock put to you. But one of the places we really like to buy those stocks, right, is when it's at price extremes or at a Fibonacci support, 200-day moving average, the golden cross or something like that happening. However you look at your charts and stuff like that, yes, you can easily implement that into these. These rules are really to try and keep you guys focused, stay mechanical. And when you guys are mechanical, when you're able to stay mechanical and you follow, why I have all these rules is when you follow the rules, you're being consistent and mechanical. And you will then have valuable data to go back and look at. If you aren't following a set of rules or being mechanical, you really don't know, or you can't isolate what is going wrong. Okay. With this, you can easily isolate it. I've set it up where it's a high probability of success for you guys, being that, 2/3 of the time the stock's not going to be put to you. Like, we don't want the stock every month, right? Some people may. I don't. But every once in a while, when I get it at a good level, then I'm definitely willing to take it and write it out. You guys watch the daily market commentaries, you know that for sure. All right. So we want to increase our probabilities of success. We want kind of an extreme to happen, would help. And then we're going to be exiting at 50% of our max profit. Or if you really want to write it out to zero because you really want that stock, write it out to zero. I'm okay with that. For the most people that are getting into this and starting out relatively new to this strategy or this type of adding, I would go at 50% of max profit and get out of it. And then at those times where it's in the money, then you're fine. You're willing to take that. You got to keep the credit anyway, and you have lowered your overall basis. Okay. So, sorry, that's not it. So 50% of our max profit. That's what we're looking for. I wanted to get the platform up here. So let me pull this platform over here, drag it over. All right. So a couple of things to do when we have that micro axis website. We can see where the correlated stocks are. You can also do it on Thinkorswim. I don't know about like some of the other ones like Fidelity or some of the others. But with TD Ameritrade, I can find correlated stocks here as well. You can set up a scan for it. Basically, you go into customize and you're going to type in correlation. And should be the first one pop up. We got correlation. We can add that over to add it over here. What's going to happen though, this is going to default to the S&P. So we can add that in. It's going to populate once it gets done thinking. And you can see like NTAP is a 96% correlation to the S&Ps. And we can go in here and we can trade, or we can customize this. I'm going to have to figure it out real quick because it's been a while since I've gone in here. I think if I click on that and I changed, I'm going to have to figure this out. I'll have to think about this for a second. But I think you can change this, what it's correlated to in regards to, if you wanted it to be the NASDAQ rather than the S&P. If you wanted it to be against XRT against the broader market, see what's correlated. I really want XRT. I want to do this correlated stock thing. What is correlated to XRT? It is going to be much more difficult than that other website, but you can do that as well by going in and adjusting that. Another thing we can do is go into the charts, create a chart of net tap, I guess is what we're going to do. We want to go up to the add a study. Let me just get rid of all these right now real quick, just so it's not confusing to everybody. I'll get rid of everything. So we got rid of everything. Now I want to go in and look for a comparison. I don't know why they name it something different, but they do. And we're going to add that selection here. Now you can see that's against the SPY. What you do is go in here and you can change SPY to whatever you want. I could put that into XRT just to stick with our example that we were talking about, okay? And add that study, apply, okay? And you can see we've got this as XRT being correlated to NTAP or net tap quite dramatically, to be quite honest. I mean, they're almost 100% correlated. Most likely not 100%. I can also change my study over here from, or the style, I mean, so it's not as confusing. I'm going to change my chart to from candlesticks to line chart just to make it a little bit easier. So this is the XRT one. Obviously, you're going to have to go in and, sorry, my dad's calling me. Guess he doesn't know my schedule. So you're going to have to go in and change the XRT every once in a while when you want to change this, you're going to have to go in there and change that one. So if you didn't want XRT anymore, maybe it's XOP now. So now I want to check XOP against everything. So hit apply, okay. I think that went to XOP. Let me just double check. I checked it. And then you can just go through and change and see, okay, there's one. That one looks kind of well, actually, it looks like it's last year. It's been pretty correlated, the ups and downs. They met ups and downs. Now they kind of separated. Okay, so that might be the opportunity to say, hey, they've been uncorrelated. They should be correlated. Now I'm going to start doing some puts, because if EWZ rallies, then I don't have to worry about it. I've got to collect the premium on all of them. But if they start coming back into line, I might be able to catch that. Does that make sense? So you can do this one. I suggest just going to that other website, because you can easily punch in one or two and see how it is in relation to 5 or 6 other stocks at the same time. It's just a little bit easier. And I'm all about streamlining the process. So I would do that. Okay. So let's just look at that one platform again real quick and try and find something that is correlated that we would want to get into. About a 70 IV percent. Let's try and go with Lulu and Adobe. As odd as that is, that would be your opportunity to get into a couple of them. You guys good with Lulu and Adobe? Let's just check it out. So now I talked about high implied volatility. That is best case scenario. We're in the middle of earnings, and volatility with the market right now has just gotten pushed out the door. So obviously we want to do this without earnings and have high implied volatility in correlated stocks. So what I would look to do is then go into Lulu, follow my rules, tight bid ask, right? So stock right around that 40, 35, 45 days to expiration should have tight bid ask, which is any stock under $100, we're looking at 10 cents wide in the option montage. Stock that is over $100, move it 3 ticks to the left, and that's how wide the bid ask should be. So in this case, right around 13 cents. It's not fitting that rule right now. Lulu does generally fit the rule after the market makes it a little bit wanky, but assuming that fits this rule as well, high implied volatility, that would be a bit of a yellow light as below 50, but maybe we expect that to go down because there's no earnings or something. The expectation, if you guys are going with volatility below 50, is that you expect volatility is going to go down. You have to have that assumption. Don't ever sell any kind of premium strategy if you expect volatility to increase, okay? Because that volatility increase is going to increase those premiums. So even if the market is in your direction, the direction you wanted to go, if you sold puts, you wanted it to go up, you sold calls, you wanted it to go down, if you expect volatility to go up, do not be selling that premium, because volatility is going to increase that premium value. So you could be directionally right and still lose money. And believe me, it happens. So with Lulu, we're going to assume that that works. What would we do? We're going to start out with at 16 delta. Oh, this one thing I want to show you here real quick is that we have the implied volatility here. So what we're going to do is look at like equal distance away. So this is trading 28, right in the middle between them for the most part. So if we go to the 120s, we can see the volatility here is 42. We go to the 30s, we can see the volatility is 41. We continue to go down, and you see the volatility skew is to the put side. All right, this volatility is based on premiums, and it's a little wanky because of the pricing. So it's getting a little wild. But look at the first couple of them. You can see that the volatility skew is to the put side, and that's what we were talking about earlier. Eric, are you comfortable substituting the criteria that you shared in last week's naked presentation, which uses the 16 delta and out of the trade the 3 or 4 days with a 30 to 40% profit? Yes, you can do that. Like if you really, William, if you didn't really want to add this stock, or maybe you were thinking, well, I'll add this stock. I'll buy Lulu at, let me give the delta down here. I'm saying we'd be selling these puts here because I'm not worried about buying Lulu at 120. You're saying, well, what if we go down to this 16 delta and I'd rather just collect it. Maybe now I'm looking at 1 out of 5 times I'm going to get hit on this trade. It's less than 1 out of 5, but I'm just ballparking right now. Then yeah, William, I don't have a problem with you moving that out further. The further away you go, the less you really want to buy this stock, right? Maybe you want to buy it 1 month out of 12. So yeah, that would work there. Okay. So yeah, you guys can play around with that. I would not be trying to sell this way out here and try and create a spread out of it. It's just your risk reward is not going to be there. And obviously the more valuable these stocks are, the further away I'm going to feel like I'm getting, but you're still going to be selling the same amount or the same delta in a sense. Okay. So, but following my rules here, I'm going to say the 30, I was saying the 36-ish delta. I would rather go further away than closer. So I'm going to start off with selling these puts here. Then I'm going to go further out into duration because this is the laddering of the puts. And then we'll go to the correlated stocks. So what I do with this one, first I start out with the 45 to 35 days to expiration. I pick around that 30-ish delta. I'm collecting around $3.80. Make it easy for you guys. This will ladder it easily. I'm just looking to collect another $30 or $3.80 to get to that. So the closest to that is the 115. So that almost doubles my premium in a sense. So that's what I'm looking for. I'm not going to pay up for it because then I'm just getting the same strike. I'm going to usually pay around the same amount. Okay. And that's what I'm looking for. That gives you just one strike further out. The easiest way to think about it, you guys. I'm just trying to ladder these out. Yes, you can go, all right, I sold the 120s. I'm just going down another strike or 2. You can even go 2 if you want. I usually just go 1 strike out. Okay. Now that we've got our Lulu, I need to do a couple of things here and make sure I switch this over to best. I want to go best and then GTC. I want blast all. Where's my blast all? Where's blast all at? Limit, blast all. So now it's going to give me where's my blast all thing? I've lost my blast all. I had it earlier today and when I was betting this. Anyway, you want it to go on blast all, so it goes to either any exchange. I guess best exchange is going to be my blast all. You don't always want it to go to a specific exchange, you guys. There's other exchanges out there. Free market price discovery is what we're looking for, and pick the best price. Now I'm going to go to Adobe. And Adobe, we're assuming has high applied volatility. It doesn't, or assume that it goes down. I'm going to do the same thing. I'm going to go to their same days to expiration, look for that 30-ish delta. Yes, you can go further out if you want on the timeline if you felt like it. I don't have a problem with that. I'm going to stick with that 30-ish delta. $5. That's a nice premium. Now I'm just going to look to get another $5 out of this. Oh, I forgot to hold down the control. Sorry. Hold down the control on that. So that's our laddered puts. But I can do these all the same if I have it on blast all, if I do it all at the same time. And then go back to what was the stock I was just looking at? you guys, sorry, was Adobe, and they were completely uncorrelated. Advanced orders, thank you. What was the stock I was just looking at? It just correlated stocks. So we were looking at Adobe and what was it? Adobe and Lulu. So Lulu is the other one we were looking at. And I was looking to do the 30-ish delta, which is the 120. So with me, I have to hold down the control button. That's when you see all these things highlight. And I want to sell the 120s. And then I want to sell the one, I don't know why it's advanced options. Maybe that's what's causing me to do this. Where's the, I should have had this all set up. I've done this before. Didn't think I'd ever forget it. And of course I am. Where's the advanced? I see you saying blast all is under advanced, Robert. Lower left corner. Oh, there we go. Single order. Blast all. Thank you. Oh, Robert's coming to the, I was sweating over here. I was sweating bullets. I'm like, where is it? I can't remember. That's the hard thing about doing these webinars. I'm trying to read questions and answer people's questions, keep myself on task, and ultimately try and think of other things as we're going along. It's a tough test sometimes. I'm not going to lie. All right. And I don't do it very well sometimes. Sometimes I'm okay. Sometimes not so much. All right. So that's how we do it. Thank you, Robert. Blast all you have to add in here so you can add in the other stocks. So I've got the 145s. Want to collect another $5 for it. You know, I can bang that one out. You know, you can pick them. It's how aggressive you want to be. You know, we were talking earlier, and William was saying, can I do the 16 delta? Yeah, you can. I'm assuming with this strategy, we want to build one. We want to build a portfolio of stocks, and we want to dollar cost average these. Yes, you can do that. William's saying, you know what? I do want to build a stock portfolio, but I don't want to be too aggressive about it. I want to pick some really good levels. Yes, you can go to the 16 delta then and do it that way. But stay consistent. You know what I'm saying? If you're going with the 16 delta, make sure you've done it enough times to where you have good data to see whether or not it's working out for you. Right? You good with that? And then I would just hit blast all on this. And I'm going to be able to collect $17, right? So think about that amount of premium. The one, I'm getting $10. So, you know, I'm lowering my cost basis by $10 if I owned Adobe and the market went up and these just expired. So if I owned Adobe, I'd lower my basis by $1. You can think about it as you got an extra dividend or something like that. If I get hit on one or the other, then I get to take that stock in. And if I got hit on these 240s, you know, you can think I paid $235 for it, right? Because that one premium was $5. I paid $235 for it. $240 for this one. So we're lowering our basis. So then if I go out and sell it, you got to remember, I'm selling it with a $5 premium added in there, which is, you know, you're going to look at your statement and you're going to say, well, I bought it at this price and sold it at that price. It's not really going to show all those stocks in there or all that premium that you sold in there. But that is what is the alpha of your portfolio, is that premium selling stuff. Okay. Does that make sense? It's pretty simple, a little bit complicated in knowing how to figure out some of the different nuances of correlation, right? But at the end of the day, we want to add these stocks to our portfolio. That's our first mandate, is I'm looking for stocks I want to add to my portfolio. Second one, William brought up a great point. How aggressive do I want to be? You know, if you're a chartist and you're looking at support and resistances with the Fibonacci's, you know, I have the regular Fibonacci's and the extensions on here. You can do that as well. You know, if it gets down to, if one gets down to this level and that level, that's where I'm going to look to add those in. And I have no problem with doing that rather than doing the delta. I'm picking support and resistance levels. Yes, definitely add that in, but stay consistent. Like I said, right. One thing, I know we got a lot of new guys in here, and I've been pounding this on my soapbox for months now, but I write down every single trade, you guys. Every single trade I do, why I put it on, what the environment was, and where I'm going to get out so that I can stay consistent, right? So I have the data written down in my book here to go back and make sure that my probabilities are better than what my delta is showing me and stuff like that because of all the rules that I implement in and around these. I expect that my probabilities during my trade are better than the probabilities delta's giving me because of the way I set it up, okay? I look at the delta as my worst case scenario probabilities. All right, 50 and 61.8 fib should hold. Exactly. Well, and that's true, especially on, when they're coming down. A lot of people like to buy at the 50 fib and at the 61 fib, right? That's where they like to buy their stocks or buy those pullbacks on futures, all right? That's why wait. Why not be proactive and continue to do that on a consistent basis? Selling those puts. And then if it gets down there, then fine, I got it. I've been waiting forever. But in that meantime, you've been waiting forever, right? That money that you would have put in as a limit or just waiting for the market to come to you before you buy it, pull the trigger on it. You've been collecting for months on end these premiums on these puts. So you're not nearly as thrown off when the market corrects and you're like, oh my God, maybe I didn't want to buy those. Well, you can hold solace, and I've collected $15 in premium. I don't care if it goes down further. All right, I see a couple of them. The 50 should hold. Francis says, what if it turns against you? Do you roll down? If it goes against me, then no, I'm probably not going to roll down because my idea here is that I want to take the stock, right? So I'm going to let them put me the stock. And then I'm going to continue to try and dollar cost average down the road. But my idea here is to, for one, play out the probabilities. Two, I'm going to let them put me the stock because I want this in my overall portfolio. If you don't want to add stocks to a portfolio, then I would go back and revisit some of my other option strategies, which are specifically just in and around trading around your margin account. Okay. Some of them I do talk about how you can lower basis on like your bond portfolio and stuff like that. But for the most part, they're more trading strategies. This is more of a portfolio strategy because there's so many people that don't understand the power of options. And to me, and there's even financial advisors, big firms that don't allow you to trade options. I think Edward Jones is one of those. It's because they don't understand them. And they should, rather than telling their customer to buy at certain levels, to be selling those puts at those certain levels so they can, increase their portfolio value. But they don't, I don't think they understood it. Do you look at the 50 fib line as a line in the sand? I do look at it. I look at all of it as a line in the sand. One thing, but this is a deeper one. This could be a moat, right? That's going to be a really strong support level. But I do look at these as support and resistance levels because there's so many people that look at them. I don't know if it has to do with just because the galaxy is a Fibonacci variable and, DNA and all these other things that I can go on and on are all Fibonacci related. That when we're trading, that Fibonacci rule holds true. I don't know if that's necessarily true. But when everybody is looking at it and trading off of it, then that kind of brings that to fruition. So at the end of the day, yes, they do. It does work. And that's what I'm going with. All right. And I know all the Fibonacci stuff behind the history of it and everything else too. I've done even webinars on it, or videos on it. But Yes, I do look at it as a line in the sand, and ultimately I'm really relying on the probabilities to get me in and out. All right, if I have sold covered call that is in the money, will this selling puts help me if I do not wish to let go of my stock? Is there any other way than buying back my short call at a loss? Not really, Benu. That's one of the things when we're selling that covered call strategy. What I would immediately start doing, knowing that I'm probably going to get my stock called away from me, is immediately start implementing this strategy. Like right now, start selling puts in that stock so that you can put the stock back, right? Even if you're selling the puts at that level where you got called away, you can do that. All right. And start doing that to add back in your portfolio. Don't ever be concerned about, like, if a stock got called away from you, I always look at that as, that's successful people's problems, right? The stock rallied up to a probability that was unlikely and got called away. Yes, that does happen to all of us. The probabilities beat us on that one trade, but immediately start flipping over. Change your mindset. I got to get that stock back. I got to lower my basis. I'm going to start selling puts against it. Oh, you have been selling puts in the same stock. That's awesome. You're ahead of the game. Hide your naked put under the 16 delta and the 50 fib to hold 3 to 4 days. Rise and rinse and repeat. You could do that, definitely. I think you're probably going to have to hold it for a little bit longer than 3 or 4 days, but best case scenario, yeah, you keep rolling those out every couple of few days, then yeah, that works out well. All right, that's about it, guys. If you have any questions, if you didn't feel you wanted to reach out to me in this, or you were watching this on tape delay, reach out to us at trading@protraderstrategies.com. I want to make sure you guys have all of your questions answered. Also, you have option premium membership trial, 1 month for $7. It's a great deal. I'm telling you, there's hundreds and hundreds of webinars and videos that you guys can scroll through. It's a nice little system where you could just check off the box and move along. You get the daily market commentaries, which I think is some of the most important information you can get, because I'm giving you real-time stuff on this, and I'm not sugarcoating anything. I've seen these other guys teach how to trade and stuff like that, and they're like, well, if you would have done this strategy when I said and did this, you would have made this much money, 600%. I don't roll that way. I probably talk about my losers more than my winners, because the losers are the ones that we have to stay mechanical with to get back to profitability. All right. And I'm not afraid to say I'm losing money in something. I'm not afraid to say, I'm having a bad month in there. It happens to all of us. The probabilities will ultimately turn. You can't make money every single month. It just doesn't happen. I mean, I do have a very long record that I don't think I'll ever beat when I was on the floor, but where I went several months with not losing money. But that's just a complete anomaly. And you will go a few months making money, and then there's a month or so that you won't make money. But that's the nature of the stock market. Same thing. You could look at an ETF portfolio and you're going to see months where you made money and months you didn't. So it's the same thing. But I go through all those trials and tribulations with you guys. You guys can see me doing this real time. So that's why I think it's so important. Also, you get the videos. There's more than 50 in there. Trading workshops. They're little shorter videos, and you get priority access to these online videos. Also, if you take advantage of this, you have unlimited access to me. You email me with a problem, I will either email you immediately back as soon as humanly possible. I have a no inbox policy. I'm going to answer everybody. And if I can't answer you on an email, I'll reach out to you and say, hey, let's set up a phone call. All right. And we'll work that out that way. So any premium membership, you get unlimited access to me. All right. and $7 for the first month. And Hector's asked, it's $97 a month after that. But you get all the videos. You can literally go through every single video and watch them as many times as you want. And once you're done watching them, you hit the check mark on it. Yes, Benu, this is being recorded. We are doing it recorded, and I'll send it out. It's pretty soon. All right, I want to thank you guys. Later webinars, I'm going to be drilling down on different option components, trades I find, when and where I find them. Here's the link also. You can, the chat. Sorry, guys. Somebody's asking, it's not in the chat window. No, it's not. I'll put it in there right now. So let's copy it over to the chat window. Dropping it in, paste, entire audience. Good to go. Should be in there. Sorry about that. Cool. Jerry, you got it? Yes. Sorry. P Trader, call us at 310-598-6677. They do have discounts and stuff like that you might be able to take advantage of if you took advantage of a full year. The other thing would be, on some of the other ones, they can do payment plans on them. Not on this one necessarily. This is a payment plan every month. But yeah, I mean, you get access to a lot of stuff. And if you guys want to start trading with high probabilities, that's how I teach, is how to increase your probabilities even further and ultimately making you more mechanical. If we're mechanical and we do it consistently, we can see where things are going wrong rather quickly, and we can then be proactive in creating more alpha. All right? So that's about it. Other than, if you can't take that, take it easy. Take care, everybody. Thank you, guys. Thank you all for your kind words. I appreciate it.